President Cyril Ramaphosa says there's no place for threats of violence or instability following the announcement of the election results. In the Head of State's weekly newsletter, he called for responsible leadership and constructive engagement. That's as his African National Congress party lost its majority for the first time since coming into power 30 years ago. This means that in order to rule, the ANC will need to share power, probably with a major political rival. Analysts have long feared that Jacob Zuma's Umkhonto weSizwe party may stir up trouble if his supporters reject the results or are unhappy with any of the outcomes. Zuma's supporters rioted and looted for days when he was arrested for contempt of court in 2021. Election jitters have weighed on factory activity. ABSA's Purchasing Managers Index fell to 43.8 points in May. This puts the reading back in contraction territory following April's result of 54 points. The deterioration was driven by a drop in demand. Numerous respondents commented that this was due to orders being put on hold as clients waited for the election results. But the weakness could be temporary. The index for expected business conditions in 6 months' time increased to 57.6 in May. Respondents are hopeful for a favorable election outcome, and that will hopefully allow for the return of put on hold orders. Shell and its SA partner Impact Oil and Gas have lost their appeal over exploration rights in the Wild Coast, and that's despite investing over 1 billion rand in exploration. The Supreme Court of Appeal dismissed the appeal bids after they challenged a High Court order that denied them the right to conduct seismic blasting off SA's coast. Environmental activists and small-scale fishing communities successfully argued that the oil companies had failed to provide proper notice and engage with fishing communities whose livelihoods would be threatened by the exploration activities in the ocean. Brait's board has approved a recapitalization plan. This includes a 3-year extension of the maturities of the company's bonds to December 2027. And the repayment or settlement adjustment to its convertible and exchangeable bonds. It also proposes a capital raise of up to 1.5 billion rand. Proceeds from the rights offer will be used for general working capital purposes and potential investment in existing portfolio companies. The funds would also be used to repay Brait's debt. After the recapitalization, the group's net debt is expected to reduce by 2.4 billion rand to 3.4 billion rand. Sirius Real Estate has delivered a strong performance for the year to end March. The owner and operator of branded business and industrial parks in Germany and the UK has posted a 35% jump in profit after tax. Funds from operations rose 8% and headline earnings per share increased 6.6%. A second-half dividend of 3 cents has been declared, resulting in a total dividend for the year of 6 cents, which is up 6.5%. Looking ahead, CEO Andrew Coombs says the firm's outlook remains positive and has assured that the business has many levers that can be pulled to unlock value and growth. Fairvest has reported a 2% uptick in distributable income at the halfway stage of its financial year. The group owns retail centres in rural areas and small towns and faced challenging operating conditions during the period. The firm says the difficulties are likely to persist, but it remains committed to its strategic objective of transitioning towards a retail-focused fund by disposing of non-core assets. Robust trade in Europe has given mass real estate a boost. During the first 4 months of the year, footfall rose over 5%. This helped keep occupancy at close to 98% and collection rates at 99.3%. Mass owns shopping centres in Central and Eastern Europe. Further afield, online fashion firm Shein is preparing to file a prospectus with Britain's Financial Conduct Authority for approval ahead of a potential London float, which could value it around $63 billion. Let's take a look at the detail in this package report.
Shein is set to file for a major share sale in London. That's according to weekend reports by Sky News. It says the online fashion giant could file for the listing as soon as this week. It's expected to value Shein at around £50 billion, or close to $64 billion. That would be a little down on the price tag put on the firm at a fundraising round last year. The Chinese-founded company has stepped up preparations for a London listing after running into hurdles over a sale in New York. It's faced pushback from lawmakers there amid concerns over its labour practices. Similar issues have also been raised in the UK, but Shein says it's beefing up governance and compliance efforts in a bid to address the worries. The company did not immediately respond to a Reuters request for comment on the latest report. If the share sale goes ahead, it would be a coup for the London Stock Exchange, which has struggled to attract big deals in recent years.
And credit ratings agency S&P has cut France's credit rating, citing its concerns about the trajectory of the French government's debt. Here's our reporter Natin Devu with more.
Well, that is right, Zinati. The S&P has cut the country's long-term sovereign debt rating from AA to AA-. Now, the agency says that the downgrade is largely due to projections that France's government's debt-to-GDP ratio will increase because of larger than expected budget shortfalls. And joining me now with more on this is DW's Chiponda Chimbelu, who is currently standing by in Berlin. Chiponda, thank you so much for your time. What are the details?
Thanks for having me. Well, Standard & Poor's lowered France's credit rating to AA- from AA, and it points to the budget deficit of the EU's second largest economy as the main reason for its decision. And while it expects France's economic recovery to continue, S&P says government debt levels will remain elevated. The good news for France is that the rating agency is keeping its outlook stable. Now, the timing of this rating downgrade couldn't be worse. S&P made the announcement just over a week to the EU Parliament elections, which are taking place from June 6 to June 9. And French President Macron's Renaissance group is trailing the far-right RN in the polls. So this news has provided opposition parties an opportunity to tout their economic proposals. For its part, the French government blames the rise in government debt on its spending to support businesses and households during the COVID-19 pandemic.
And Chiponda, maybe perhaps you can paint a picture for us on how this compares to other EU economies.
Well, it will probably make sense to look at the EU's 5 biggest economies. So Germany, France, Italy, Spain, and the Netherlands. Now, 3 of these countries' debt exceeds their GDP. Italy has a whopping 140% debt to GDP ratio, and France and Spain were both hovering around 110% last year. Germany and the Netherlands are both below the EU average of 83% debt to GDP ratio, and that is, of course, also where we see a divide in Europe between countries that advocate fiscal discipline, like Germany and the Netherlands, and those that prefer more fiscal freedom, like Italy, France, and Spain. Not everyone in the EU believes fiscal prudence is the way to go for the bloc. There are arguments that spending on climate change, for instance, is not irresponsible but an essential investment. It is not just about helping the bloc reach its climate change goals. It's also about ensuring that the EU is competitive globally. The US has been spending billions on energy and climate change in its Inflation Reduction Act by providing subsidies for companies investing in green technology. So the argument is that the EU needs to keep up. But the question is how it can raise the money.
I guess let's get into that, Chiponda. How will Europe pay for the investments it needs to make?
Well, that is the trillion-euro question, because the EU's Green Deal, which aims to make the bloc's 27 member countries climate neutral by 2050, requires annual investments of up to 1 trillion euros. Now, that is a huge sum that would be challenging to raise even in good times. Now, Russia's invasion of Ukraine has meant that that European countries have had to spend more on defense. Meanwhile, Europe faces energy supply shortages, rising inflation, labor shortages, and, of course, slowing growth. So governments are asking how to finance the investments they need to make. And one of the challenges will be getting the 27 member states to agree to a solution.
Well, let's leave it there for now. Thank you so much for those updates. That was Deutsche Welle's Chiponda Chimbelu.